This is the Retirement Lifestyle Advocates radio program. I'm your host, Dennis Tubbergen. Glad you decided to listen in today. Hey, joining me on today's program in segments 2 and 3 will be Mr. Murray Gunn. Murray is an analyst with Elliott Wave International. I'll get his take on the conditions in Europe. I caught up with him about a week ago from his offices near London. And I'll get his forecast for stocks, bonds, currencies, and commodities. So you'll want to stay tuned for that. It is the month of October. That means I have a special report for you. The October special report is titled Anatomy of a Recession, Strategies for the Current Economy. I'd be glad to send you a copy along with bonus information, including 2 of my best-selling books. You'll receive the Little Black Book on Social Security Maximization. You'll also receive the Revenue Sourcing book that contains strategies for the current economy, along with the October special report. Go to requestyourreport.com and just let us know where to mail all that information. We'll be glad to do so. Again, this month's special report, Anatomy of a Recession, Strategies for the Current Economy. That's yours by visiting requestyourreport.com and letting me know where you would like me to mail that report to you. So we have the current situation in the economy, and that's my topic for this segment. The current situation in the economy, in my view, is that we are in a recession. Now, the Federal Reserve, the central bank of the United States, has been increasing interest rates, and to listen to them, it's pretty clear that they're going to continue to do that. Now, at their last meeting, the central bank raised interest rates to 3.25%. And the goal, of course, stated by the Fed is to get the inflation rate back to the bank's long-term target of 2% annual inflation. So these moves to 3.25%, another move perhaps coming. The question is, will they get the job done? Certainly, if you've been to the gas pump, certainly if you've been to the grocery store, it seems that inflation is still raging. It seems that it hasn't made a difference. And my take is this. These moves by the Fed are more form than they are substance. I believe they will not accomplish the objective of getting inflation back to the stated 2% target. I'll talk more about that in a moment. What I think these interest rate hikes will do, however, and I think we're now seeing it in the economy, is I think these interest rate hikes will likely catalyze a deeper recession. Now, I think this recession was inevitable. If you've been a long-time listener to the program, you know that I have talked in the past about the very high debt levels that exist in the private sector and in the public sector. In fact, we hit a milestone this past week when U.S. government debt officially exceeded $31 trillion for the very first time. Now, as many of you know, if you've been a long-time listener to the program, I like to study history and identify situations that have existed previously when economic conditions look a lot like they do today. And from that study of history, I've reached the conclusion that when debt levels reach a point that they are unsustainable, and I would say we are in that situation today, deflation and recession at that point become unavoidable. Now, if you've been listening to the program since the beginning of the year, and here we are now halfway through October, since the beginning of the year, I've made the case that we are in a recession. The first 2 quarters of 2022 saw economic contraction. That meets the textbook definition of a recession. I would expect the third quarter will also report anemic data at best. So the big question, if you're thinking about retiring, if you want to have a secure, stress-free retirement in what is shaping up to be a very difficult environment, the questions are, where do we go from here economically speaking, and what should you be doing? Well, let me share with you a bit of a perspective and a bit of an opinion here. It's my view that we will continue down this stagflationary path on which we now find ourselves. Now, what is stagflation? Stagflation is defined as inflation coupled with economic contraction or recession. Now, let me get back to talk about why the Fed's actions to date, I believe, are unlikely to tame the inflation monster. Simply put, to get inflation under control, interest rates need to be positive on a real basis. In other words, interest rates need to be higher than the inflation rate. If the inflation rate is higher than the interest rate, you are incentivizing spending. In other words, since saving money will result in savings losing purchasing power, it makes more sense to spend the money than it does to save it. Now, let me share with you an example using current conditions. Now, Yahoo Finance recently reported that the benchmark U.S. 10-year yield was around 4%. It got as high as 4.015%. When this article was published, it was 3.945%. So let's just say that we have the 10-year yield at about 4%. So if you go buy a 10-year U.S. Treasury note, you'll get about a 4% return. Now that's up significantly, and the bond prices, as many of you know, are down significantly since the first of the year. But getting back to the example, if you go invest in a 10-year U.S. Treasury note, you'll get an annual yield of about 4%, yet the official inflation rate is over 8%. Now, we could talk about the fact that the official inflation rate is actually a manipulated number. I would argue a heavily manipulated number. But let's just take these numbers. We have a yield on the 10-year note of 4%. The official inflation rate's over 8%. So let's just do some rough back of the napkin math. And when we do that, we find that we lose about 4% annually in purchasing power by investing in a 10-year U.S. Treasury note. Now, if we turn the clock back to 1980, then Federal Reserve Chair Paul Volcker was dealing with a similar situation. Mr. Volcker increased interest rates to nearly 20%. Inflation was brought under control as a result because real interest rates were positive. Now, if you go back and take a look at the way the inflation rate was calculated pre-1980, which economist John Williams of the website ShadowStats does, you can visit shadowstats.com to check out his excellent work. Mr. Williams says if we calculate the inflation rate now the way they did pre-1980, the inflation rate would be between 16 and 17%. That would tell us that we really need to raise interest rates to about the level Mr. Volcker did again if we want to get inflation under control. Now, if we go back to the numbers that existed in 1980, the Fed funds rate was 18%. The 10-year note paid 12.5%. There was a 5.5% real positive interest rate. Now, until we get real positive interest rates, it's my view that inflation will not get under control. And that's why I believe we'll have inflation in consumer prices for longer than a lot of analysts out there who are pontificating about how long inflation will last. I think it's going to last longer than many of them are predicting. So when you take a look at where the Fed is right now, I believe the Fed is powerless to get this inflation rate back to 2%. Given the debt levels that exist in the economy, which we've discussed already in this segment, they are at extreme levels. If we were to see the Fed increase interest rates to the magnitude that they would need to get inflation under control, it would literally bankrupt the economy and the U.S. government. Now, briefly, in the time I have left, I mentioned at the top of this segment that U.S. government debt is officially at $31 trillion. Now, at a 4% interest rate, the cost to service the interest on the debt is about $1.2 trillion. However, if the interest rate were to go to 17%, the cost to service the debt would be $5.2 trillion annually, and that's more than total U.S. tax revenues. That alone, I believe, is the reason the Fed can't raise interest rates to a level that would get inflation back to the 2% target. Now, ironically, the Fed's sudden resolve to control inflation by increasing interest rates is slowing the economy. And there is no dispute that the first 2 quarters of 2022 has seen economic contraction. Now, if you would like more information, if you would like some ideas as to what you might do with your money, I'd like to invite you to get our October special report. But it's really more than a special report. It is an entire information package. You'll get the report titled Anatomy of a Recession, Strategies for the Current Economy. You'll get 2 of my best-selling books. You'll get 2 recent client-only newsletters. It's all free. Visit the website, requestyourreport.com, and let me know where to mail this information. I'll be glad to do so at no cost to you and with no future obligation. The website again, requestyourreport.com. I'll be back after these words. Welcome back to RLA Radio. I'm your host, Dennis Tubbergen. Joining me on today's program once again is returning guest Murray Gunn. Murray is a market analyst for Elliott Wave International. You can learn more about Elliott Wave at their website, elliottwave.com, and there is a free book resource available there as well. I would encourage you to check out. And Murray, welcome back to the program.
Thank you, Dennis. Pleasure to be here.
So, Murray, as we are speaking, I am on the west side of the Atlantic. You're on the east side of the Atlantic. And there was some excitement in the UK here over the past couple of weeks. The Bank of England came in and pretty much shored up the gilt market, or for U.S. listeners that might not be familiar with that term, the long-term bond market. Can you fill us in a bit as to what happened?
Sure. Well, the global bonds have been in a bear market since really 2020, and when Elliott Wave International, we were warning our subscribers since 2020 that a bond bear market was coming, and so yields have been rising in global bond markets since then, and it's obviously been accelerating this year. I mean, this year's been probably the most historic bond bear market in terms of price. When yields go up, price goes down in history, and so. What happened in the UK was just an acceleration of that trend. The conventional analysts have blamed it on the fact that the UK government decided to announce a policy of unfunded tax cuts. But as usual with the conventional way of looking at things, people try to put a rationalization as to why things happen. You can look at the movement of the 10-year bond gilt here, and the yield, did accelerate higher over those few days. But the fact of the matter is that it was already moving in that direction anyway. And from our analysis point of view, from the price pattern recognition point of view, it was just part of that trend. But it caused a bit of a panic over here. We certainly, got the headlines, which is, we can maybe come on to that in a minute about sentiment. But it caused a panic, caused the Bank of England to step in and buy long-dated bonds in an intervention, because if they hadn't, then a lot of pension funds in the UK would have had trouble meeting margin calls on some of their leveraged investments that they had been structuring at the what we call the long end of the gilt market.
So, Murray, it strikes me, and thank you for that explanation, but it just strikes me that, the very fact that pension funds are using leverage or borrowing money to invest strikes me as really a symptom of how artificial these markets seem to have gotten, in my view. What's your perspective?
I think that's very true. I mean, the government rules and regulations as usual, have unintended consequences, much like what happened in the US with the housing boom back in the late 90s and into the mid-noughties, that it was government policy that kind of encouraged that sort of lending to be done in the housing market. Government policy here for pension funds has made it easier for the derivative industry to structure and what we call synthesize investments into long end or the long end of the gilt market and for pension funds in order for them to meet their obligations. So, but yeah, I mean, what's interesting is that as markets move, as things develop, as with every derivative. I mean, Warren Buffett famously called derivatives weapons of mass destruction, and he also said that famously that when the tide goes out, you can see who's been swimming naked. And so, with a lot of these pension funds, their leverage was kind of hidden until we got this big volatility in bonds this year, and so that's what's exposed some of these pension funds to the fact that they were swimming without any underwear on.
And a fitting analogy, I might say. So Murray, I mean, this just happened in the UK. This problem, though, is probably not going to be confined to the UK. Don't you think that we're going to see this again? The Bank of England will probably intervene, but won't other central banks around the world be faced with the same scenario?
Well, I think with regard to the specific investments and derivative investments that were being used at the long end of the UK bond market, they're kind of specific to the UK. There's not the same extent that goes on in other markets, other developed markets like the US. There's not really that problem there. But in general, yes, your point is correct. I mean, the more volatility we have, and we're still, even with what's going on this year, we're not at extreme levels of volatility. So there's still scope for more volatility in bonds, more volatility in equities, and when we have fast moves in the market, and it's not the kind of with derivatives like this and being exposed to margin requirements, it's not particularly the direction of the move, it's more the speed of the move that takes place. So if we get fast moves in bonds again and fast moves in equities, which we haven't really seen this year so far, then it will expose pension funds, investment funds, and others as to anyone who's been leveraged.
Well, if you're just joining me, I am chatting today with Mr. Murray Gunn. He is an analyst with Elliott Wave International. You can learn more about Elliott Wave at elliottwave.com, and there is a free book resource you can take advantage of there as well. Murray, just shifting gears a bit, here in the U.S., the number one economic concern, according to recent polls here, is inflation. The Fed here has been talking tough, that they're going to continue to raise rates until inflation is subdued. They get it under control. Give us an update on the inflation situation in Europe.
Well, there's if you want to see an historic chart which will make your eyes pop out, I would suggest looking at a chart of the consumer price inflation rate for Germany, which has just gone into double digits on an annualized basis at over 10%. And that's the highest rate, certainly since the end of the Second World War. And the chart is pretty vertical. So there has been a big issue with consumer prices going higher here in Europe. A lot of it is to do with the cost of energy. Obviously, natural gas prices over here are continue to be very high, through the roof, and people are blaming that on issues with regard to the war in Ukraine and geopolitics with Russia. But there's the basic fact remains that European central banks, and in concert with other central banks around the world, maybe not to as much of the extent as the US, but in the last number of years they've been engaged in basically the proper definition of inflation, which is monetary inflation. People think that we've become used to calling inflation or defining inflation by consumer prices, but actual inflation is what is an increase of the money supply and specifically credit and debt in an economy, and that's been rampant in Europe and especially in the US over the last few years. So the fact that we're getting this consumer price inflation problem now really shouldn't be a surprise to anyone, really, especially the central banks.
So, Murray, in the time we have left, the action that central banks are taking, I guess in my view, seems to be, to use an old analogy, a lot more bark than it is bite. They're talking tough, but it seems like they're probably not doing enough to get inflation under control, in my view. And I think the debt levels dictate that they probably can't. Would you agree or disagree with that statement?
I think that's a very fair point. There's a real balance here. I think the central banks would be quite happy to see the market do its work, for it. Long end yields going up, stock markets coming down, the economy slowing. I mean, we just had employment data today as we're speaking on this Friday, and it showed a drop in the unemployment rate in the US, and that's something the Fed will not really particularly want to see. I mean, the Fed will want to see a weakening labour market because that will be associated, or has been associated historically, with consumer price inflation dropping.
Well, we're going to leave it there. The clock says we are out of time for this segment, but I will return after these words with my special guest, Mr. Murray Gunn. I'm Dennis Tubbergen. You are listening to Retirement Lifestyle Advocates Radio. I have the pleasure of chatting once again today with Mr. Murray Gunn. Murray is an analyst with Elliott Wave International. I certainly encourage you to check out their website at elliottwave.com. There is a free book resource available there as well. I would encourage you to take advantage of. And Murray, in the last segment, we were talking a bit about the bond market, and you used the term sentiment. And I think a lot of investors and a lot of folks saving for retirement maybe aren't even familiar with that term. But can you talk a little bit about Elliott Wave's work and the role that sentiment plays in your forecasting?
Well, sure. The Elliott Wave principle is what we call a fractal-based model of the economy, discovered by a man called Ralph Elliott in the 1930s, and he discovered that human herding behaviour causes markets like the stock market, which is a leading indicator of the economy, to really exhibit certain identifiable and repeatable patterns throughout time. And these patterns, he discovered that they repeat at every time scale. And so really the principle enables cycles of herding behavior to be anticipated from the very short term to the very long term. So it's people that, it's human beings that drive markets, full stop, at every time scale. And so that's why we, as Elliott Wave principal practitioners and what we call technical analysts, we don't study the economy to think that the economy is going to lead the stock market. We study human behavior because that's the driver of the stock market, and that is sentiment.
So, Murray, let's talk a bit about your specific forecasts. You analyze, I think, European markets, but can we talk about your forecast for stocks in general? Year to date, here in the U.S., the major stock market indices are down between 20 and 25%, depending on what day it happens to be. Where do you see stocks moving from here?
Well, continued downtrend, really. When we last spoke in June, I think it was, I reiterated that our view that the bounce in the global stock markets from the 2020 pandemic lows was the final rally in a multi-decade bull market, and that 2021 in particular, based on our cycle analysis, could have marked an historic juncture in the topping process, and it certainly seems to be bearing out that way, and especially with the bear market in bonds, of course, because the rise in yields in the bonds, that's what we call the risk-free rate, that feeds counter directly into equity market valuations. But it's really the fact that social mood is turning, what we call social mood, which is, we mentioned sentiment earlier on. You can think of social mood as kind of long-term sentiment, but we might talk a bit more of that in a minute. It's really because social mood has been turning negative, and so yes, we've been bearish for a while and continue to be bearish. There's nothing in our pattern recognition analysis that tells us that there's an end to this downtrend anytime soon. So yes, we continue to be bearish, and another 10, 20% over the next few months wouldn't surprise us.
Let's talk a little bit more about social mood. I know Elliott Wave has, to my recollection anyway, really invented a science called Socionomics, and it'd be interesting, I think, for our listeners if you chatted a bit about that.
Sure. So Robert Prechter's socionomic theory stems really from hard evidence that it's the trend in social mood that determines social actions, not the other way around, as most people think. Most people think that if something negative happens, then the mood of society then turns negative. But the socionomic studies and historical studies suggest that it's the negative mood trend comes first before the negative action. And of course, vice versa for positive action. So, for example, conventional thought would be that recessions cause business people to be cautious, whereas the socionomic way of looking at that would be that to say that it's cautious business people who cause recessions. So, because social mood is the driver of everything, it tends to show up first in the stock market because that's where people can action very quickly. And so the trends in stock markets can anticipate social actions. And also social actions can help us anticipate where we are in the stock market cycle. And I think I mentioned the last time, and a clear example of this was what happened in Russia at the start of this year. I mean, the Russian stock market topped out in 2007 and had been in a bear market since then. So negative mood in Russia, a negative mood trend in Russia had been in place since 2007, and at the end of at last year, the start of this year, well before Putin went into Ukraine, we suggested to our subscribers, based on the pattern recognition and the socionomic analysis, that it was very probable that Putin would actually have this negative social action of going into Ukraine, whereas a lot of people were still, judging whether that would happen or not. And it's obviously another good example, Dennis, is just what's happened in Italy this year, just recently, with the election of the first far-right government since Mussolini. So the Italian stock market topped out in 2000, that's 22 years ago, and it's still less than half the value it was back then. So there's been an obvious negative social mood in Italy for 2 decades. And so it's unsurprising to socionomists like ourselves that Italian politics has lurched to the right.
So, Murray, where do you see bond markets going from here? Is there more downside in this bond bear market that, as you mentioned in the first segment, has really been historic?
We think so, yes. Certainly our pattern recognition analysis suggests that yields can continue to move higher. The one really interesting aspect, Dennis, this year has been the fact that corporate bonds have held in relatively well. And we think that could be the next shoe to drop in the bond bear market. I mean, yields in corporate bonds have risen along with bond yields in general, but they've not seen the level of underperformance that has historically been seen as the world has moved into recession. One reason for that could be that corporate borrowers took advantage of the basically free money that was on offer in 2020 to kind of term out, what they call term out, or lock in their borrowing for a few years. But now that's starting to be needing to be rolled over, that debt. And so next year, many corporates, I think, will find it very difficult to finance their operations as they roll over that debt. And of course, that will increase credit downgrades and defaults.
So, Murray, in the time we have left, I'd like to chat, if we could, a little bit about currencies. The U.S. dollar has been strong relative to its trading partners. I always like to remind people that a strong U.S. dollar index doesn't mean the dollar is gaining in purchasing power on an absolute basis, but relative to other currencies, it's strong. Do you see the strong dollar trend continuing?
Well, yes. I mean, it's interesting. In I think it was 1971, the Treasury Secretary in the U.S., John Connolly, said to his global peers that the dollar was our currency, but your problem. And that attitude seems to be prevailing today, I think, with the relentless appreciation of the U.S. dollar. And it's obviously adding to problems in emerging markets, making their external debt more burdensome. And in developed economies where import prices are rising. In fact, just today, the German import prices were rising at their fastest pace in 50 years. So the strong dollar is a problem. Some people have suggested, we could get something like the Plaza Accord, which came in 1985 to weaken the dollar. But we think that because social mood is turning negative now, whereas it was broadly positive back in the mid-'80s, that's kind of unlikely. But our pattern recognition analysis suggests that the dollar could actually be close to a significant turning point. It looks like we're still in for a little more appreciation, but that should be the last wave in the dollar's appreciation trend, with 2023 looking more like a period of potential dollar depreciation.
And quickly, in the time we have left, Murray, any comment on commodities? Oil prices have been all over the place. Recent announcement by OPEC to cut production. Oil and other commodities. What's your forecast?
Well, at the start of this year, our analysis was suggesting a top in commodities. At least an interim top was very possible, around the level of I think it was 331 on the Commodities Research Bureau Index, the CRB index, and we alerted our subscribers to that. That forecast was made purely on the basis of price pattern recognition and ratio analysis, which is what we do. And it was actually in June that the CRB topped out pretty close to that level. I think it was 329, and it's down about 15% since then. So in the medium term and in the next period, our outlook for crude oil is currently bearish, looking for another decline towards around about $60 a barrel range. But after that, it should start, based on our analysis, it should start another advance, which should take it above this year's high. On gold, the outlook from price pattern is not that clear, but a rally in 2023 still looks quite probable. But that differs from like you look at industrial metals like copper, and that certainly looks like it's topped out, and now in a significant downtrend. And that would be consistent with a slowing global economy.
Well, the clock says we're going to have to leave it there. My guest today has been Mr. Murray Gunn. Murray is an analyst with Elliott Wave International. The website is elliottwave.com. There is a free book resource available there I would encourage you to take advantage of. Murray, always a pleasure to catch up with you and get your perspective. Thank you for joining us today. I'd love to have you back down the road.
Many thanks, Dennis. It's been a pleasure as always.
We will return after these words.
Welcome back to RLA Radio. I'm your host, Dennis Tubbergen. Glad you decided to listen in today. And thanks again to my special guest, Mr. Murray Gunn, for joining me on today's program and offering his perspectives as well. We do have an October special report that is now available. It's titled Anatomy of a Recession, Strategies for the Current Economy. In the report, we talk about the difference between an inventory-driven recession and a debt-driven recession. I'll talk about, in the report, what often happens to financial asset prices during a debt-driven recession, like the one I believe we are in now. I'll talk about that more in this segment, and I'll also give you some strategies to consider presently. In addition to the report, I'll send you a couple of copies of my best-selling books, including Revenue Sourcing and the Little Black Book on Social Security that will help you maximize your Social Security. You'll get the report, both books, as well as a couple recent client-only newsletters. All you need to do to get all this free information is visit the website, requestyourreport.com. Let me know where to send it, and I'll be glad to do that for you. Again, the website, requestyourreport.com. In the last segment, I talked about the fact that it's my belief that inflation cannot be brought under control until we have real positive interest rates. And now, if we use some of the alternate inflation calculation sites that are out there, and these sites typically track the inflation rate the way the inflation rate was calculated by the government pre-1980, we now have official inflation somewhere in the teens. Officially, it's around 9%. So the conclusion here is, and I bring this up for context, if inflation cannot be brought under control unless interest rates are increased to levels that will bankrupt much of the economy, don't we have to conclude that inflation will not be brought under control? And I believe that as the economy moves into a deeper recession, the Fed will reverse course likely, and they will once again support the economy via lower interest rates and more currency creation. Now, these efforts, I believe, will ultimately fail. And I say that for many reasons, but this big reason, this primary reason. The real problem in the economy today is excessive debt. When you create currency, it only makes the debt problem worse because today's currency is debt. Ever since 1971, when then President Richard Nixon eliminated the link between the dollar and gold, At that point, the dollar was no longer directly redeemable for gold at a fixed rate. At that point, money was loaned into existence. So if you create more currency, you're creating more debt, and you can't solve a debt problem by creating more debt. Now, Egon von Greyerz of Matterhorn Capital, whose work I admire and read, said this. He said the current stock market crash has the potential to extend to a 30% fall in the next few weeks on the way to a 90% fall in the coming years. He said in his working lifetime over the last 50 years, he's seen the official U.S. inflation rate go from 5% to 15%, down to negative, and now back up to 9%. He said for over 10 years, the Fed tried to get inflation up to 2% and failed, and now it's 9% and rising, and they'll have zero chance to get it down to 2% for years. He quoted Thomas Jefferson, as I often do. Jefferson said, inflation will precede deflation. And I believe that's where we're headed. And again, this month's special report will give you some strategies to consider for your situation. And again, to request that report, if you're just joining me, along with the bonus information, visit requestyourreport.com. But when we talk about stocks in the February 2022 special report, I noted that stocks appeared ready to begin a decline. Now, if you received the February special report, you can go back and take a look at it. But in that report, I referred to two different stock market valuation measures. One is the Shiller price earnings ratio. And I noted that that ratio was pushing 40, which exceeded by about a third, about 33%, the level of 30 in 1929, when we saw a 90% decline in the value of stocks. The second indicator that I looked at was an indicator that is now often referred to as the Buffett indicator. The Buffett indicator simply takes the total value of stocks, the total market capitalization of stocks, and divides by gross domestic product. Now, even after the decline that we have seen in the market this year of way more than 20%, the Buffett indicator has stocks still being more overvalued today than they were at the time of the financial crisis and at the time that the tech stock bubble became unwound, or started to unwind, I should say. So the Buffett indicator is extremely elevated. And keep in mind, the denominator of that fraction, gross domestic product, is declining. So I think that my forecast for stagflation moving ahead appears to be on track. That's why I would invite you to get the October special report, Anatomy of a Recession, Strategies for the Current Economy. Just visit the website, requestyourreport.com. Let me know where to mail that report, as well as the bonus information. And again, you'll get a copy of the Social Security Maximization book and the Revenue Sourcing book, as well as the report and current client newsletters. So again, that's requestyourreport.com. That's all the time I have for this week. Hope you got something you can use. I'll be back again next week.